So we're going to do chapter 3 today, which is adjusting entries, right? So a couple of the things that we're going to talk about is we're going to explain the importance of the periodic reporting, right, and the time period assumption. We know the time period assumption in the first chapter. Time period assumption is that we can break down the financials into different periods of time, right? Whether it be, I don't know what the heck that was. Whether it be weekly, monthly, yearly, and so on. We're going to explain accrual accounting and how it improves the financial statements, right? And identify the steps that it takes we're going to identify the accounting cycle. We're going to work through the accounting cycle. So by the end of this, we would have gone from all the way to what we call closing entries. We're going to explain and prepare a classified balance sheet. Up to this point, we've been doing a non-classified balance sheet. We will be doing a classified balance sheet. Everybody with me? All right, so let's get started. We'll start with the periodic system. The periodic time period assumption. The time period assumption is that we can break the financials down into N type of time period, right? Monthly, quarterly, semi-annually, annually, what have you. Oh, for you who've seen these slides, did y'all see the PowerPoint in the background? Yes? Yeah? Anybody else? Well, next week I'll ask you again. Right? Okay, but just let me know if you can't see it. All right. So I haven't said this yet directly, but there are two bases of accounting when we're doing financials, right? Cash basis and accrual basis, right? Cash and accrual basis. Cash basis of accounting, and this defines when we recognize revenues and expenses. In the cash basis accounting, we recognize revenue and expenses. We recognize revenue when cash is received. We recognize expenses when cash is paid. We recognize revenue when cash is received. We recognize expenses when cash is paid. So therefore, every transaction under the cash basis has cash in the transaction, whether it be debit cash and credit, credit revenue, or whether it be debit and expense, like wage expense and credit cash. Every transaction in cash basis has cash in the transaction. Are you with me? The other form of accounting is, or the other basis of accounting is accrual. Accrual basis, we recognize revenue when our client legally owes the money. When they legally owe us, we recognize revenue. And when we legally owe our creditors or our vendors, then we need to recognize the expense. So what does that mean, Mr. Jenkins? That means that if you are, let's say, Capital One, and you have utilities, and you pay Dominion Power. Under cash basis, you do not pay Dominion Power until you pay the bill. Dominion Power sends you a bill every month. When you pay it, that's when you expense it off your books. However, if you're using accrual basis, you do not pay, you don't recognize the expense until you receive the bill. When you receive the bill, it's an expense, not when you pay. Everyone with me? All right. Right. Out of these two examples of two bases, cash basis is not regulated by GAAP. It's not a GAAP-based accounting. Accrual is. Most small businesses do cash basis until they get to a certain size, and then the government regulates that they can no longer do cash basis. They have to do accruals. So once you get to a certain size with your business, you have to do, it's government mandated, that you do accrual basis. I believe you have to have $1 million, less than $1 million in revenue to be on cash basis. But if you're over $1 million, then you have to be on accrual. What group do you think that the government would allow to have more than $1 million in revenue and stay on accrual basis?
You mean cash?
Revenue. What group do you think that the government would allow to have more than $1 million of revenue and stay on accrual basis?
Churches?
Huh?
Churches?
No, not churches. No, well, no.
Government agencies?
Yeah, government, right. They're the only, right. They would make a rule for everybody else but them. Yeah, they're the. I don't get the irony of that. All right. Recognizing revenue. The revenue recognition principle states that we recognize revenue when the product or service is provided to our customer and the amount expected to be received from the customers. Basically, you have a legal transaction. When you have a legal transaction, that's when you can recognize the revenue. For example, if I was sold some goods from, what's your name?
Alex.
Huh? Alex. So Alex sold me some goods. Alex sold me a $5 billion wind turbine. I said, sure, Alex, I'll buy it. I'll send you the money tomorrow. Alex can't put that on his books because I don't have $5 billion. I don't even show the ability to have $5 billion. That make sense? So that's not a legal transaction. Or if Alex came and said, I talked to President Trump, and President Trump bought $5 billion worth of wind turbines from me, that still might not be a legal transaction, because one would say, well, did you really talk to President Trump? Did he sign off? Let's see where he signed off on that transaction. Everyone with me? So you just can't claim something. It has to be legally done. Recognize expenses. The expense recognition or matching principle aims to record the expenses in the same accounting period as the revenues, right, that they generated. The matching of expenses with the revenue benefits a major part of the adjusting process, right? So we're trying to put expenses in the same period in which the revenue they generated. Right? Everyone understand it? So let's get an example. Fast forward, pay $2,400 for 24 months of insurance on a policy. If you were looking at this on a calendar under cash basis, it would look just like this. We paid $2,400 for an insurance policy on the December 30th, 2013. But it's a 2-year policy. So the rest of the months would look like what? 0, right? Now, if you came in as an outside investor and looked at the company's 2014 books, and you saw 0 for insurance expense, you might think that they don't have insurance. They're a company that is not covered. That would draw a red flag. Everyone with me so far? Companies need insurance. Now, if you were to look at this on accrual basis, it would look different. And although we bought the insurance in 1 month, December, we would expense that insurance over the next 24 months that we had it. What does that mean, Professor Jenkins? That means on January of 2015, 2 years later, you still have insurance. I, as an outside investor, would know you have insurance because I could pick up your financial statements and see a line item for insurance expense. Everyone with me? So I would know you have coverage. And this is the way the rest of this class will be taught. We will use accrual basis. We're not going to use cash basis anymore. Cash basis, you got to know where we're going to use cash basis. When I told you that cash will be in every transaction. That means most of your transactions are only 2 accounts. If cash would have been 1, then that means you would have only had to know the other half of the accounts. You only have to do half the work. Sorry. You know, you got to do it. So, accrual accounting is what we'll be doing. And under accrual accounting, we have adjustments. We have 4 basic adjustments, right? We have prepaid expenses, right? So when you pay cash before the expense is recognized. With unearned revenues, that's when you receive the cash before the revenue is recognized. You have accrued expenses. That is when you pay cash after the expense was recognized. And you have accrued revenues. That's when you receive the cash after the revenue is recognized. There are 4 basic categories. So, does everybody have this down? Go ahead.
Oh, is this recording?
Yes. So you can ask the question, you hear your question again. Just because this is recording doesn't mean you don't ask questions. That makes sense? If you have a question, ask the question. You'll see in the other classes recordings, there's a lot of questions. As a matter of fact, this recording that I'm doing right now, we will probably finish today. Theirs, we've done for 2 days and we're not finished. Unless you have a lot of questions, then we won't be finished today. Which is perfectly fine. So next slide I'm going to show you is a framework for these adjustments, right? And it's just a mindset or a process in which to complete adjustment entries, right? That framework basically works in these 3 steps. First, determine the current account balance. Second, determine what you want that account balance to be. And then third, record an adjusting entry to get from step 1 to step 2. So first, you want to look at the current account balance. The second thing you want to do is figure out where you want that account balance to be. Where are you going? Where are you and where are you going? And then last but not least, is figure out how to get there. What's the adjusting entry to take you from step 1 to step 2? So let's go back to the prepaid insurance example. Does everybody have this down? Or it needs more down? All right, so let's go back to the prepaid insurance example, right? Here's a check for the first 24 months of insurance. What is happening? What has happened is when they first pay the insurance, the prepaid insurance account is going to increase by $2,400. Everyone with me? Why? Because that's a debit to the prepaid insurance and a credit to cash. So it's $2,400. However, we're going to use $100 a month. So let's say on December 31st, let's say we bought the insurance December 1st. Now it's December 31st. A month has been used. So we need to subtract 1 month's worth of insurance from prepaid insurance. Well, how are we going to accomplish that? Well, the first thing, how we're going to do it, we're going to debit insurance expense and credit prepaid insurance. Everyone with me? I'm going to debit the insurance expense and credit prepaid insurance. That way, our balance will be equal to what we're looking for, $2,300. Because that's how much in prepaid insurance you have left after you've used 1 month of insurance. Everyone with me? And this is the transaction. Here's your transaction. Debit, insurance expense, credit, prepaid insurance. And that will bring the balance down. Is everybody comfortable with the T accounts? This is a debit or a credit? This is, okay. Let's do another account. Let's do supplies, right? So here, fast forward, purchased $9,720 of supplies in December. Some of these were used during December. The fiscal count shows that the supplies equals $8,670. So the supplies account started at $9,720. We want it to be $8,670. How do we get it to that point? Well, we've got to credit the supplies account by $1,050. Everyone with me? So if we're going to credit the supplies account, well, then what are we going to debit? Scholars, I ask you, what would you debit? Yeah, $1,050. What account?
Supplies expense.
Supplies expense. Fantastic. So we're going to debit the supplies expense and credit the supplies account to get the supplies account down to $8,670. Everyone with me? And here's your journal transaction. Now, the next adjusting entry I'm going to show you is depreciation. Depreciation is another transaction that we're going to make. All these transactions we make at the end of a period, right? At the end of the period, these are just transactions that need to be put in the books to bring them up to current level. Now, depreciation is our accounting's estimate of usage of an asset. It's accounting's estimate of usage of an asset, right? Now, I'm not going to have you, I'm not going to make you responsible for calculating depreciation right now. I will make you responsible for calculating it later, because it will come up in chapter, I think it's 8. I think it's chapter 8. So there's an entire chapter on depreciation. So I don't need you to be worried about it just yet, but in the future, there will be a chapter. But for now, we'll basically give you what you need to calculate depreciation. This is a straight line, but if they make you calculate it, they'll have all the numbers. If not, they'll just give you the depreciation expense, and you'll need to know how to do it from there. So here, fast forward purchase equipment for $26,000. The equipment, well, hold on, let me use this other example. I'm gonna do this one. January 1st, Barton Inc. purchased equipment for $62,000 cash. The equipment has an estimated useful life of 5 years. And at the end of the life, they expect to get $2,000 cash for it, right? So it's a simple equation. 62,000, the cost minus the 2,000, which is the cash they plan at end of its life. They expect it to be worth $2,000 divided by 5 years, and you get $12,000 a year. And that $12,000 a year represents the depreciation. And so that's a depreciation expense. What you would do, you would debit depreciation expense and credit accumulated depreciation. The majority of the stuff that you're going to have between now and Chapter 8, they'll just tell you how much the depreciation is. You need to debit the expense, credit accumulated depreciation. Go ahead.
Can we go back to that equation? For
Okay.
depreciation? So is useful life the number of years?
Right.
Okay.
Yeah. The number of years they anticipate to use the asset. Okay. Now this account, accumulated depreciation, is my introduction to you of contra asset accounts. Contra accounts, let's just start with contra accounts. Contra accounts run contra to whatever account they are in. So in this example, contra asset account, this is an asset, or this account is reflected in the assets of the balance sheet, but they run contra to it, or negative. So there's subtraction to that asset. So in this, here's your balance sheet, here's the assets, here's equipment for $62,000. Less the accumulated depreciation, minus $12,000 gives you $50,000. A contra asset is in the assets, but it's a negative to assets, not a positive. Everyone with me? The 50,000 represents the book value. Later on, we'll start discussing book values also. Right. Some things might have a value on the books, but might not be their true value. And another thing is unearned revenues, right? It's when we receive cash prior to us providing the service. So here, fast forward, clients paid a 60-day fee in advance. So what they did, I'm going to give you a timeline here. They paid on December 27th. For service from December 27th to February 24th. Let's say this is 2017 and 2018. In the middle of this contract is the end of year. Everybody with me? And that's December 31st. So what happens? They need to put the 27th through the 31st. That revenue needs to go into 2017. Everyone with me? So, when they first receive the cash for the revenue, they're gonna debit cash, credit unearned revenue. They need to put 5 of the 60 days into 2017. So 5 divided by 60 times 3,000 is $250. So what they're going to do, they're going to, I'll just show you the transaction. They're going to debit unearned revenue, unearned consulting revenue, $250, and credit consulting revenue, $250, to put this revenue in 2017 where it's earned. Does everyone understand? They're trying to make sure that $250, they've earned it, those days have passed, but it needs to go into 2017, this fiscal year. So in order for that to happen, we're going to debit unearned revenue and credit consulting revenue for that period, December 31st. Go ahead.
Do we still enter the total amount or just this one?
Yeah, just this piece. And then let's say on February 4th, the journal transaction will be for the rest of the amount. So we would debit unearned revenue for $2,750, which is the remaining amount. If you look here, 3,000 minus 250 is 2,750. So we debit the remaining amount and credit the revenue for 2,000 to put that revenue into 2018 to book it. Everyone understand? This is your February 4th transaction, and this is your December 31st transaction. Questions? All right. Next transaction is when you accrue an expense. Most of the expense that you accrue is with wages. People work a period and then they get paid in a different period, right? Or sometimes individuals, in this example, will work through the end of the calendar. So here, the last pay date was December 25th. The next pay date is January 1st. So in between is December 31st. Same concept here, where we're talking about the revenue being put in 2017, but now we're talking about making sure the expenses are in 2017. Everyone with me? We haven't paid the expenses, but we're trying to make sure we put them in 2017. So I'm going to use, I think this example is the one I'm going to use. Yeah, because it's, wait. So here, Fast Forward pays its employees $70 per day, or $350 for a 5-day work week. Salaries are paid every other week, so every 2 weeks, so that's for 10 days, right? So if they pay $10 a day for $70 per day, how much do they pay every pay period? How much do they pay every pay period, scholars? $700. Fantastic, $700. It's just the $70 per day times the amount of days, which is 10. Now, on December 31st, the Wednesday, so there's only 3 days that are going to be in this pay period. So 3 times 70 is $210. Make an adjusting entry to increase the salaries payable, increase the liability salaries payable, and increase the salaries expense. So we want to make this entry, debit salaries expense, credit salaries payable. Let me show you. So on the 31st, let me go back one more. On the 31st, we want to make this entry to make sure the 3 days of salaries are expensed on the 31st. Then 7 days later, when the payroll is due, on January 9th, we're going to make this entry, which is a debit to salaries payable for the 3 days that we put in 2017, a debit to salaries expense for the 7 days that we have in 2018. And there's your 10 days. And we're going to pay them that day, so we're going to credit cash for all 10 days. That makes sense? When we initially did the expense, it was a debit to expense, credit to a payable. That means we know we owe you. We're going to put it in the 2017 year, but we're not going to pay you until later. Payable, salaries payable is when you owe it, you legally owe it, but you're not going to pay it. Everyone with me? Crude revenue. Crude revenue is revenues that are earned in a period that are both unrecorded and not yet received, right? So fast forward, on December 12th, fast forward's customers agreed to pay $2,700 on January 10th of the next year for future services over the next 30 days. On December 31st, there were 20 days worth of services that had been provided. So they're owed for that period. They want to put it in 2017. So you're going to take the 20 days divided by 30, which is 0.66, times it by $2,700, you get $1,800. We need to debit our accounts receivable and credit our consulting revenue to put those revenues in that year. That makes sense? Now, have we received those revenues? Have we received the cash for those revenues? No. We're not going to receive it until January 10th. But did we earn the money? Yes. Everyone with me? All right. In the future, when we do receive the money, we're going to debit the cash. This is January 10th. We'll debit the cash, credit the accounts receivable, because now they don't have a receivable. They paid it off. They don't have a line of credit with us. They paid off the 20 days they owe, and credit the $10 for consulting revenues. At this point, I would encourage everybody to go over these transactions, right? Again, the slides should be up. If they're not, I'll make sure to put a note for them to be put up so you guys can look at them. These are pretty simple transactions, right? These transactions, let me get back to the accounting cycle. So at this point, your accounting cycle should look like this. You should have received a transaction. Once you receive a transaction, you figure out if it's material or immaterial. If it's a material transaction, it comes with a source document. You record the transaction. Once the end of the period happens, those transactions come from a T account where they've been summed to this unadjusted trial balance. Now, being that we did this last week, some of these things should look familiar. Some of them should look familiar from this week, right? $9,720 debit to supplies, right? Or a $6,200 that's adjustment. Or here, this $26,000 in equipment. And some of this should look familiar. And this is just an unadjusted trial balance. This is the summation of your T accounts. And unlike last chapter, we just had a trial balance and we just went straight to the income statement. Here, we're going to have an unadjusted trial balance and we're going to have adjustments. So what are the adjustments? The adjustments are the things that we just did. They are the things, scholars, that we just did. For example, the supplies has a credit for $1,050. I'm sorry. The salaries expense was $210. Remember, it's 3 days and $70. So that's a debit for $210. And a credit to salaries payable for $210. Prepaid insurance. Remember, we spent 1 month. 1 month was $100. So there's a debit to insurance expense and a credit to the prepaid insurance account. Is everybody starting to see this? So you're going to take your unadjusted trial balance, take your adjustments, and all you're going to do is summarize these to get the adjusted trial balance. So it's nothing complicated here. So if you have a debit, if you have 2 debits, like here, salaries expense and the unadjusted trial balance was $1,400. We have a debit adjustment of $210. You just add those two together and you'll get $1,610. Everyone with me? Now on the opposite side, if you have a debit and a credit, so here you've got supplies for $9,720, and you have an adjustment for a credit of $1,050. You take the difference. So you have the $9,720 minus $1,050, you get $8,670. Everyone with me? If you had 2 credits, here you have a credit for $5,800 for revenue. Then you have a credit for $250 and $1,800 for revenue. You add 2 credits together and you'll get a credit for $7,850. And last but not least, if you have a credit and a debit. So here, the unadjusted trial balance is a credit for $3,000. And you have a debit on the adjustments for $250. You subtract these. 3,000 minus 250 is $2,750 in the credit. Does everyone understand that? If they're both debits, you add them. If they're both credits, you add them. They are debit and a credit, then you subtract. Find the difference. Go ahead.
So this is monthly,
It could be any time period you want.
so for the following one, for like the insurance, would you just keep on doing 100 each
Yep.
month?
Every month you do 100. Yep. And this is what you have. Now once you get this adjusted trial balance, you're home free. Because now you're back to making your 3 financial statements. The first one is what? What's the first? Huh? No. Go ahead. Income statement. Your first financial statement is your income statement. And your income statement is right here from the revenue and the expenses. See? So you just take this revenue and expenses and transpose them onto the income statement. No work needed at this point. Just need to know where stuff goes. And you get the net income. After you net the net income on the income statement, what's the second statement you need to make? Statement of retained earnings. Fantastic. And what are you gonna do? You're gonna take the net income off the income statement. And then you are gonna get the cash dividends. The cash dividends comes from the, if you see here, it says dividends, $200, comes from the adjusted trial balance. Beginning retained earnings plus net income minus the dividend gives you ending retained earnings. And the last financial statement you create is the balance sheet. Fantastic. And that is where you'll take the two pieces of information. One from the adjusted trial balance and transpose that onto the balance sheet. The assets are here. They're exactly the same numbers. You just put them on. And then the last number you'll need is the ending retained earnings. That goes down here in the equity section. And you'll have your balance sheet. Any questions, comments? There are a few more slides to go, right? At this point, let me show you. I'm going to take you forward a couple of slides. I want you to see this. At this point, I've taken you from analyzing the transaction, right? Determining if it's material or not, journalizing it, debit and credit, posting it, making an unadjusted trial balance, putting in adjustments, making preparing an adjusted trial balance, preparing the financial statements, income statement, statement of retained earnings, balance sheet. The only one we're missing is statement of cash flows, but that's chapter 12. Now I've gotten you to the closing. So this is as far as this is where we are as far as the accounting cycle. The closing, and then I may show you a little post-closing. Everyone with me so far? So I just wanted you to see the map. So let me go back. So closing entries, when you close the books, very, very simple. It's not a complicated process. Closing the books, you're going to determine if the accounts fall into one or two different categories. If they are temporary accounts or permanent accounts. You're going to figure out, scholars, if they are temporary accounts or permanent accounts. It's a great thing here. Permanent accounts, well, let's start with temporary accounts. Temporary accounts, we will close. We close all temporary accounts. Permanent accounts, we do nothing to. That's the greatness of it. We do nothing to permanent accounts. We close temporary accounts. Now here's a little shorthand for you to help you identify a temporary and a permanent account. All of the accounts on the income statement are temporary accounts. All of the accounts on the income statement are temporary accounts. So that means you need to close the income statement. And then on the balance sheet, dividends are temporary. The rest of it is permanent. So if you close the income statement and you close the dividends, you are home free. You don't have to do any more work. So let me show you an example. And And this just highlights more what is it? Close the revenue accounts, close the expense accounts. Well, if you close the revenue and expense accounts, you close what? The income statement. Everybody with me? Close all the revenue accounts, you close all the expense accounts, you close the income statement. And then we're gonna bring in an account called income summary. I'm gonna show you how that works. So let's say all your revenue is 25,000 credit, all your expenses are 18,100 debit. You have retained earnings of 7,000. We're gonna have this account called income summary. And what we're gonna do is basically gonna be an account that we're gonna dump all of our revenues and expenses in. So we want to close our revenue account. We want the ending balance to equal 0. How do we achieve that if we already have $25,000 credit for the ending balance for revenue? What do? Debit it the same amount. So if it's credit 25,000, we're going to debit 25,000. But if we're going to debit it 25,000, what's going to be the corresponding credit? The corresponding credit is going to be to income summary. Everyone with me? So it's going to look like this. I'm going to debit the consulting revenue and credit the account onto the income summary. All right, so after we do that, now we need to move the expenses. So what are we going to do? It started as an $18,100 debit. To zero that out, we need to do what? Credit the expense account $18,100. And when we credit $18,100, that'll make this 0. We'll debit that onto the income summary. Now the income summary has all the revenues and all the expenses on it. So that means that the total of the income summary equals what? If the income summary has all the revenue and all the expenses on it, the total equals what? Net income. Yep, net income. Everybody with me? Now we're going to put that net income onto the retained earnings. So if it's a credit of $6,900, how do we close this or make this account 0? Debit it $6,900. Simple, right? Very simple. Whatever the account that you're closing, you need to zero it out. So you need the opposite transaction to the summary. Now we've got the retained earnings. We've got the net income, which is the revenue and expenses. So the last thing we're missing is the dividends. How do we get that dividend number over to the retained earnings? If the dividends is $2,000 debit, what do we need to do to make it 0? Credit, right? Credit the dividend account $2,000, debit it over to the revenue account, makes it 0. That is in the ending retained earnings here should reflect the same number you have on your statement of retained earnings. Okay? That's closing process. The post-closing, what you should see, and this is basic stating, but what you should see is zeros for the income statement, and then the balance sheet should look exactly the same as it did pre-closing. Everyone with me? The income statement should be zeros, the balance sheet would look the same. That will come up in your final. So please remember that. And that's the cycle. Last but not least, I just want to make sure we're going to talk about the balance sheet, the difference in the balance sheet now. is that in a classified balance sheet instead of a non-classified balance sheet, is what we're going to do is we're going to sort the assets and the liabilities in order of liquidity. Liquidity. When I say liquidity, when it comes to assets, it is how fast we can change those assets into cash. On the asset side, there will be current assets. These assets can be turned into cash within a year. And there will be non-current assets that'll take more than a year. In the liability side, there will be current liabilities. Those cannot be turned in. You don't owe them, I'm sorry. That's when you owe. And the current liabilities aren't owed until a year, within a year, and non-current liabilities or long-term liabilities are owed longer than a year. And this is what that balance sheet will look like. Current assets, then long-term assets, current liabilities, then a little bit longer-term liabilities. Everyone with me? That's it. It's just your ratios from there.